A lot of companies, if you go to their websites, they have their presentations, their PowerPoints, the stuff they bring to and present at investor conferences. There's never been more information at your fingertips. Most people don't know when they know something. Most investors don't really know when they know.
Hello everyone, and welcome to a new episode of The Blunt Dollar. Today we're joined by Stephen Gray, the founder and managing principal of Gray Value Management, where he oversees the Gray Value Opportunity Fund.
I've always viewed the market as a character test. It is a tale told by an idiot, full of sound and fury, signifying nothing. That is the stock market.
There's incredibly nice and genuinely interesting people in the industry. And what would your advice be for someone entering the industry today to have a successful career as yours? This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello everyone, and welcome to a new episode of The Blunt Dollar. Today we're joined by Stephen Gray, the founder and managing principal of Gray Value Management, where he oversees the Gray Value Opportunity Fund. Stephen's career has taken him through the worlds of hedge funds, private family offices, and global macro investing. And he even helped launch Albright Capital Management alongside former Secretary of State Madeleine Albright. Stephen holds degrees in law and business from Tulane and Columbia and has been both an expert witness in securities litigation and a panelist at investment conferences. Outside of finance, he's a seasoned motorcyclist with over 100,000 miles, 150,000 miles, I believe, worldwide, a first responder and a flotilla commander in the U.S. Coast Guard Auxiliary. In this episode, we'll explore why regulatory guardrails matter, how complacency in motor investing creates both risks and opportunities. We'll also dig into the human side of due diligence, the psychology of markets, and why Stephen believes we take trust in financial statements for granted at our peril. Stephen, I'm super excited to have you on the show. Welcome to The Blunt Dollar.
I am very excited to join you, Nacho. How are you?
I'm very, very well. And yeah, let's get things going. The first question I always like to ask my guests is, what is your day-to-day look like? So what is it that you're doing at Gray Value Management? And yeah, how do you typically operate?
That's a really good question, and it's one that I'm happy to answer because it speaks to a question I'm always asked by allocators, which is, what is your edge? That always comes up. And it's very much part of our process. I start every day, basically the first 2 or 3 hours, reading a half a dozen newspapers, going to different websites and other news resources, and just hoovering in as much information as I can. Of course, I'm looking for information about companies we own, companies that I might be interested in, industries, what's going on at the national and international level, macro. I've been doing that for at least 25 years now, every day. And so if you think about the cumulative effect of all of that information and that knowledge, and I actually keep track of that information. I take notes every day. And so I've assembled sort of quite a digital and internal library when it comes to information. It's funny because I hadn't thought about it until I was getting ready for this conversation with you, but I got it started investing at a very early age, and my father was a very good investor. He was very interested in investing. He was very good at it, but he was a corporate pilot. And so he didn't work on Wall Street, and he was never trained in finance or investing, but he did every day read the Wall Street Journal front to back. And honestly, it wasn't until about 15 minutes ago when I was thinking about having this conversation with you that I realized that I really very much inherited that habit from him. Of course, we'll probably talk about Jim Rogers, who I studied under at Columbia, had a huge influence on me. And it's, this taking a panoptic view of the world and trying to be aware of and wired into what's happening and thinking about it objectively and aggressively, not just looking, but trying to see.
Mhm. Yeah, I mean, what you're saying about the Wall Street Journal resonates so much with me. In my case, it's more the FT, but a lot of times I have people approaching me asking for tips on how to learn about markets, what should I study, which degree, which books, and I'm like, seriously, just get a subscription to either Wall Street Journal or the FT and read it every single day as much as you can. Like, and whenever you find something in there, a term, you name it, something that you don't know what it is, just Google it and
Yeah,
do that consistently for 3 months, 6 months, and 1 year. And I can guarantee that after 1 year, you'll know more about markets than the vast majority. I mean, you'll be in the 1% out there. It's as simple as
absolutely.
that.
Absolutely. And I read the FT every day as well, the New York Times, the Nikkei Asia, several other newspapers overseas. And now add to what you just described, reading the 10Ks and the 10Qs and the proxies every day.
Yeah, that's next level. For those of you that don't know what those are, is like the financial statements of banks, right? That are freely available. For in the case of American companies, you can go to the SEC website and you can access it. It's beautiful documents, like 300, 400 pages long, but where you have basically all the information about the company. And Stephen here is a specialist in going through those. You're probably the quintessential finance nerd. I like to say I'm the finance nerd, but you're probably a lot nerdier than me.
Shall we start having get-togethers? We can do a different city every year. That might not be a bad idea, actually. That could be fun.
Get
But yeah, I mean,
togethers
if
to
you
go
think
through
about it, I mean,
10Ks.
we're talking about, I mean, the seminal document for most companies is the annual report. And if you look at the management discussion section, I mean, that's where they tell their story. That's the narrative. And then on top of it, a lot of companies, if you go to their websites, they have their presentations, their PowerPoints, the stuff they bring to and present at investor conferences. There's never been more information at your fingertips.
Yeah, there's almost too much of it. But yeah, investor
That's another
relations
point.
page are amazing. I love investor. It's a bit of a nerdy thing to say, but the presentations that you get in investor relations pages about companies where they present their business, like not all of them have them. Like a lot of times they just focus on quarterly presentations and annual reports and things. But sometimes they have these corporate presentations. And when I started working at HSBC as a fixed income analyst, I had to a lot of times, like, I was covering primary markets and I had to explain to our clients what the company was about when they were coming to the market with some new issues. And I would just go to the IR websites, and whenever you found a good presentation there, you're like, oh yes, this is so interesting. um,
Well, that's, I mean, again, I mean, we're gonna keep giving one another segues through this conversation. I mean, a lot of the time when investors ask me what my edge is, I say my curiosity. If you're actually curious about what you're doing and the information in front of you, that drives that process, that instinct to try and actually figure things out. That's how you transition from just looking at information to seeing, to distilling information into actual actionable insight. The curiosity and the drive to actually understand, I think, go hand in hand. And there's so much about Wall Street now. In a lot of ways, the industry, asset management in general, particularly in the United States, but I think on a global basis, has sort of transitioned from investing to allocating. Think about most people when they sit down with a financial advisor, they never talk about individual securities. They come up with some kind of pie chart and they say, well, you should have about, based on who you are and your goals and your age and your income, you should have here's the pie chart. You should have 20% in US equities, maybe 10% in international equities, and it all comes down to some pie chart. But people aren't actually looking at what's going on, and it makes sense. They don't want to look under the hood because the goal of the asset management industry is to automate the investment process. because that's how you get leverage. That's how you generate profits. That's the margins in that business come from eliminating as much individual judgment as possible, right?
And not everyone has time either to, go at the single line level and make studies and spend hours and just making research. They want to delegate that.
It's also, I think it's a really good point, because I was thinking about, like, if a major Wall Street firm came to me and said, listen, we'll give you access to all of our resources, as much money, as many analysts as you need, I probably couldn't do what I do, because all of that administration, all of that operational apparatus would, in many respects, I think, undermine the seminal process of identifying those investment opportunities, not to mention the obvious challenge of managing money at a place where your approach is basically betting against the people you're sitting next to.
Mm. Yeah. So tell us a bit more about what is it exactly that you do today. How do you, how do you work at Great Value Management? What is the thing that makes you different from the other investors out there?
Well, I think we've already covered a lot of it, right? I mean, I don't attempt to automate anything. There is no algorithm. There is no template. I do not use screens. I just look for interesting investment opportunities. I mean, I'm a contrarian by nature, but I also, in my opinion, I don't know how you can be a value investor without being a contrarian, because, when you're value oriented, and we can talk about how value investing has been hijacked as a category, as a term, but when you're value oriented, you're looking for upside and a big margin of safety, right?
Mm-hmm.
And you're not going to find that in anything that is straightforward or obvious. Those kinds of extreme mispricings are either going to be a situation that's contrarian or obscure, or maybe a little bit of both. So for example, if I have a position in something that you've heard of, it's probably because everybody hates it.
Mm.
And that's just a lot of it. I mean, I guess to get you a little bit more insight into my actual process, everything that I do, all of that assimilation of all that information, inevitably I'll come across something that seems interesting. And fundamentally, if the market may not be efficient all the time, but it's efficient most of the time. And if that's the case, then most of the time, if you find something that's interesting, it's probably not trading at an interesting price, because the market's efficient most of the time. And so what happens is I start following things and learning about them. Whether it's initially an industry, and then I start digging into the companies, or I see something about a company, and then I wind up learning about the industry, because you have to understand the industry to understand the company. I'll keep learning and analyzing, and then I'll arrive at what I describe as a price that offers an irresistible risk reward. I'll decide what that price is based on my analysis. I don't use any outside analysis. I don't use any Wall Street research. I do my own spreadsheets from scratch. And then I wait for either a market-wide or a company-specific event to give me that price. And if I don't get that price, I just continue to follow it and monitor it, learn more about it until that happens. And maybe, I have companies on my list that has never happened yet.
And how big is that roster of companies? How many companies do you monitor at the same time? Are we talking
probably
about 10
about
companies or like 1,000?
About 150.
Okay.
And so if you think about it statistically, the longer that list is, the more likely it is on any given day that some event causes one of those companies to hit that tripwire, to trade down and give you that opportunity to buy at a price that truly presents an irresistible risk reward. I run a concentrated portfolio of maybe 15, 20 positions.
Okay.
That's also critical to my process as well. If I had to have a portfolio of 50 positions, I couldn't do it. It would be impossible. I mean, maybe with some more people, more analytic horsepower, I could definitely have more positions, but I run a very concentrated portfolio because I want to understand what I know, what I'm invested in inside out.
Hmm.
And
Yeah,
so,
that's what one of the things that surprised me when I was researching for this episode was how deep you go into the companies you cover. Like it's phenomenal. Like and in the prep call we made, you walked me through your process, but I don't know if everyone goes as in depth as you do when it comes to researching names. Tell us a bit more about the specific steps you take, and when do you consider that you know a name properly enough?
yeah, I kind of tend to beat them to death. We average between 200 and 400 hours of research per name.
It's pretty
And,
big.
but I mean, if you think about it, I mean, okay, let's frame this properly. Yeah, there's training and experience involved. You have to understand some accounting and financial reporting. But other than that, anybody could do what I do. I don't have any special resources or information at all. I'm getting, everything that I use, anybody else could get online and obtain. So it really is just the effort. And I'll be honest. I mean, generally speaking, after I've put maybe 10, 20, 30 hours into something, that's about all it takes for me to feel like I've got something going on. There's probably an attractive opportunity there. I mean, on my radar, my initial impression has been confirmed. And what I do, and in many ways, I view this as a fiduciary and even ethical obligation to my investment partners. The next 180 hours is making sure I'm not wrong and and I'm protecting their money. How hard are you willing to try to not lose money? That's really the question. I try really hard to not lose money. And our hit rate for our fund, which is now over 10 years old, is extremely high. Historically, our impairments, actual losses, is extraordinarily low. But if you think about it, things can happen that you couldn't predict. COVID, global pandemic. Uh, but we're all human, which means our judgment is flawed, which means of course, we can all make mistakes. The question is twofold. How effectively can you minimize the number of mistakes you make? And based on that process of minimizing them and the standards that you impose, how much money do you lose when you do make a mistake?
Mhm. Yeah, and I'll add on top of that, it's okay to make mistakes, but someone told me this in another episode, but I think it was Soros that said it at some point. But it's okay to make mistakes. What is unacceptable is not learning from your mistakes and making that same mistake twice. But yeah, coming
Yeah,
back to the hours, oh my God, like 200 to 400 hours per name. I mean, by the time you stop researching, you know the company better than the CEO. For God's sake, that's insane. Wow.
yeah. I mean, I've testified as an expert witness for a reason. I was brought in by the DOJ and the SEC to testify in the only successful prosecution of a bank CEO following the great financial crisis. And they had gotten a hold of my research, and they just wanted to put me and my research in front of the jury. I just went I was in court for a week or so, and I just told them what was there.
So they contacted you because they knew you had researched this name and they knew you had researched it in depth and that there was pretty much no other analysts out there or very few that would know the bank so well and inside out as you. Is that it?
Yeah, I don't know how they originally came across me. I mean, I guess I was probably on the shareholder list, and then they saw my research and they realized that, I mean, nobody knew that bank as well as I did.
Wow. Well, that's pretty impressive. And
Yeah, I mean, and
yeah,
I appreciate that, but I'm emphatic. It's, anyone can do the work. In a lot of ways, the question simply is, how badly do you want it?
yeah. Yeah, everyone can do it, but not everyone is willing to put so many hours in there. I think that's definitely what sets you apart. That grit and that almost obsession with the names that you decide to cover and take positions on.
Yeah,
It's
I
pretty
appreciate
cool.
that, and I won't dispute that, but I think you know one of the things for me very early on in my career, I noticed something. That very fortunately, I noticed something, and that was that there are a lot of really smart, well-educated, well-trained, pretty hardworking people in investment management that were horrible investors that got horrible results, and I started thinking about why that was the case. And most of them were really bad investors and really bad performance. And um, it came down to several things. And the most important, I think, which is something I talked about, I was invited to visit Hillsdale College and talk to the students there who are in business or finance about how my liberal arts background influenced my career in investment management. They said the one thing that people never talk about that's so critical is just fundamentally good judgment.
Mhm.
And if that doesn't seem self-evident, think about how well you would do if you had consistently bad judgment. If you're cursed with consistently bad judgment, you are destined for failure, right?
Mm.
But then, you take it down another layer and you think, well, what is good judgment about? Discipline, patience, maintaining a calm, a detachment, an objectivity, not getting emotional, not getting greedy. A lot of it comes down to character traits. And I've got a book coming out next year about our investment approach. And
Oh,
the bulk
nice.
of it is dedicated to specific investments we've made over the last decade and a half. But in the introduction, this is what I talk about. It really is. It really does come down to basic character traits because the rest is really just arithmetic. You have to
Mm.
understand the labels on the other financial statements and what they mean. But as you said, you can go out and learn it, and you can, learn it just by starting to analyze different investments.
So
Reading an annual report and that sort of thing. It really does come down to those traits.
mm,
And
we'll have
having
one
maybe,
reader here
the
for
200,
sure.
200 hours of research, well, yeah, I mean, I guess there's some discipline involved there. But again, my edge is my curiosity, right? I actually
Mm.
want to understand. And it's one of the things that in the panel discussion I was involved with up at the SEC in Washington about a month ago. One of the things that I talked about was, there's no reasonable person standard that's imposed on, investment banks, investment management firms, or Wall Street analysts in terms of what's the minimum they should do. I mean, is it professionally responsible or ethical to recommend investing in a company if you haven't even bothered to read the annual report? The most important, comprehensive, readily available piece of information out there. I've always thought that, I would love to get I have a background in law, representing some aggrieved investor and have, the head of the investment firm or the analyst who made the recommendation say, well, what did the annual report say? How many annual reports did you read?
Mm.
You're representing yourself as an expert. Of course, you've read all the filings, haven't you?
Well, I would expect so. If it's an analyst covering the stock,
But a
that's
lot of financial
the base.
advisors and these people, they actually have no idea what they're talking about. They're very good at sounding like they know what they're talking about, but they truly don't.
Mm. And talking about good judgment, and I'm going to ask you please to put the mic a little bit closer to your mouth. Is it some? I mean, reading between the lines of what you were saying, are you? Do you believe that we can learn good judgment, or is it like just genetic? And just there's no way you can get better at it.
Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
It's a really good question. It's sort of an existential question, isn't it? I mean, that's one for the Greeks and the Romans. I think that you can cultivate certain qualities. I think you can cultivate patience and discipline. I think that, I mean, of course, maybe there are some people that are just simply prone to panic, and that's the way they'll always be. Human beings are certainly inherently susceptible to greed. When somebody asks me, well, do you want to make a lot of money fast? I say, no, I don't.
That's no, that's interesting. I guess this. I wanna think that there is a part that you can definitely learn, but you need to be surrounded by good examples, good role models, good mentors. There's probably a part that is genetic that you cannot change, but a lot of it can at least be emulated. And yeah, I want to think that with the right people around you, everyone can become a decent investor. Maybe not the best in the world, but at least to the point where, well, you get more good calls than bad calls, and when your bad calls are bad, then you're not losing too much, and when your good calls are good, then you're making enough to compensate for the bad ones.
You're speaking directly to what was the main point of my presentation at Hillsdale, which was this idea of a classic liberal arts education, including the classics. I mean, we're surrounded by these great teachers and advisors. I mean, that's what posterity is providing us. I read Marcus Aurelius all the time, Aristotle, Plato, all of the great authors. I talk about Heart of Darkness, which is the book written by Joseph Conrad that Apocalypse Now, that movie, is based on. And he talks about in that book how you have to always be careful to recognize that when your strength is the accident of another's weakness. And all of these themes that have what I see as very direct, immediate application in the investment context. And I've always viewed the market as a character test. Because it really it's about those qualities. It's I think it's hard to do a thorough job and not understand what you're buying or selling.
Yeah.
And the market may not cooperate in the short term, but over the long term it tends to the market tends to be efficient. And it's easy to let the noise get the better of you. But that's life. There's Shakespeare, the Macbeth, the famous soliloquy. I talk about it. Tomorrow and tomorrow and tomorrow creeps in this petty pace from day to day to the last syllable of reported time, and all our yesterdays have lighted fools the way to dusty death. Out, brief candle, life's but a walking shadow, a poor player that struts and frets his hour upon stage, and then is heard no more. It is a tale told by an idiot, full of sound and fury, signifying nothing. That is the stock market, full of sound and fury. Those prices bouncing around every day, every moment, full of sound and fury. They don't signify anything. Shakespeare was telling you what you should do.
Wow.
Are you listening?
I love that. Absolutely. No, it's amazing. So you said that you've read a lot of philosophy. Which concept from the field of philosophy do you feel has shaped the most the way you look at markets today?
It's funny because I had this great philosophy professor. I went to UT Austin for undergrad, and he wanted me to major in philosophy. He was a Texas guy, but a very respected philosopher and academic. And I told him I was probably going to go into finance investing. I was going to law school and all of this. And, and he said, so, you're you want to make a lot of money. And I said, yeah, well, I mean, I guess so. And he said, his response was, well, there's a lot of money in philosophy if you have the right one. So, I thought that was, I always remembered that. I thought that was pretty interesting. But I mean, in terms of philosophy, mentioned Jim Rogers. He had a huge impact on me. And I can remember, there were several moments. I had him there was about every 5 years or so at Columbia Business School, he would teach a seminar that he ran like a hedge fund. And you would apply. You had to submit a resume and like a 1-page statement of why you wanted to be in the seminar. And he let about a dozen people in. And he had 3 former students who were co-professors. So it was like, I don't know, 12, 15 of us and 4 of them.
Is it one day or like a full semester?
It was a full semester.
With Jim Robert.
With Jim Rogers, yes.
That's amazing.
And you agreed on what industry or sub-industry you were going to cover. And then based on his format, in terms of the way the Excel spreadsheet should be laid out and that sort of thing, the financial analysis. And also you had 1 page to make your investment case. Every week, 24 hours before class, you had to drop that off hard copy at his place. And then the next day you had to stand up and in Socratic fashion defend your investment while the 4 of them just hammered you. But
literally hammered, like they were just throwing the hard questions.
What are you talking about? Why would you say that? What does that mean? How is that relevant? What did you base that number on? Why does that make sense? Just unrelenting.
Roasting you.
Yeah. Yeah. I mean, it was just, and all, none of it was never ad hominem. It was always based on the facts, the investment argument, but he would just eviscerate you. And we also had regular class time with him. And I remember one time he asked, he asked a question and I raised my hand and I started my answer with, well, I think, and he slammed his hand down on the table and he said, I don't care what you think. What you think is useless to me. Tell me what you know. And that was the big light bulb moment for me. That was sort of the epiphany. I mean, there were a series of them in that semester with him, but that was the one that really went home because it's, part of all what we've been talking about and all this analysis that I do and what other people can do, a big part of it is doing it enough for long enough and intensely enough to understand in an honest, accurate way when you actually know and understand something versus telling yourself you do. Convincing yourself of what you want to believe about something as opposed to authentically, objectively analyzing it and coming to an authentically objective, fully informed conclusion. Most people don't know when they know something. Most investors don't really know when they know.
Didn't you ever think about working with Jim afterwards, or there was no possibility to do that?
Yeah, he ran for as long as I've known, he's run his own money. I remember him mentioning it. I forget which major firm he had his account at, but it was Merrill Lynch or Morgan Stanley or one of those. But I remember him mentioning that the only condition he had placed is that they never call him and try to sell him anything or give him any advice. The day that happened, he would move the account.
Wow.
Which, I mean, if you're Jim Rogers, you don't need or want their advice.
Mm-hmm. Gosh, it must have been super interesting to get them to get him to teach you so early on in your career and have those epiphanies early on and really pushing you to the limit. Definitely a great opportunity for you.
It was incredible, and that's sort of been a continuing accident of my existence. And that, my father, I mentioned, he was a corporate pilot. The guy he worked
Mm,
for most of his career was an individual named Benno Schmidt Sr. He had a son that's relatively well known that was held several very high level academic positions. But Benno Sr., the first venture capital firm was called J.H. Whitney. That was launched when Jock Whitney, who is part of the Whitney family, famously wealthy, that's the Whitney Museum in New York
mhm.
City. Um, the two of them partnered with the idea that they would take a lot of this capital that could be going to small, promising businesses and make sure that they got the money that they couldn't borrow from banks that wasn't really then accessible in the capital markets. And the whole idea was that it would be an adventure in capitalism, which they shortened to venture. They were the ones that actually, Benno was the guy who coined the term venture capital. He created the asset category. I grew
Oh,
up
wow.
with my father as his pilot, and Benno took a liking to me, and I used to fly around with them all the time. And I would follow the deals they were doing and listen to what they were working on. And people like Henry Kissinger on the board, the exposure I had just by virtue of that accident. And, there's a company, a global resource company, which has taken changed form and substance quite a bit over the years, but Freeport McMoran was one of the big global resource companies.
Mhm.
It was Benno that first identified Freeport Minerals, which was a Texas company that was quite small at the time, and built that into Freeport McMoran. He was the
Wow.
person who was the architect of that.
Gosh, that's insane. I love how, yeah, that it, your dad's job and his passion for markets like kind of permeated into your whole existence. And yeah, that's pretty cool. Like, wow, it's almost like you were destined to success, like with that kind of exposure with guys like Jim teaching you early on. I mean, you had no excuse, Stephen, not to be successful.
What is success? It's funny because I actually, over my right shoulder in my office, I have a picture of Benno hanging up there as a reminder. I am grateful to him for a lot. Um, I mean, I have. If you go to my website, you'll see I wrote a letter to an investment advice columnist when I was 13 about this utility stock that I was looking at. Like, you're talking about investment nerds, right? And I'm looking at the yields and utility stocks at
Did
13.
they answer?
They did. Yeah, I mean, that's why if you go to the website, it was the Star Ledger, which of course is no longer a newspaper in print. I think it's available online, but um, there was a guy named Bill Doyle who wrote a column called "According to Doyle." He was one of the first investment advice columnists, I think, in the U.S. And he printed my letter and he printed his response. That is what he would do if you wrote to him, and that's what I have posted on the site because it's
That's pretty cool.
yeah. Um, so I've been interested in it for a while, and it's definitely, it helps. It's an advantage to start early
Hmm.
because of the learning process, and then later, of course, when I joined forces with Madeleine Albright and the Albright Group in launching that firm that became Albright Capital, and that was focused on investing in emerging markets with an emphasis on frontier economies.
Yeah.
Um, being with her and going through that process and then traveling around the world with her. I mean, I was in Mexico City and Moscow, and I spent time in Bosnia. We did deals in South America, Africa. It was all over the world, Asia.
Wow.
That and being able to be next to her um, for so much of the time. And of course, she was not an investor, but she was a brilliant woman, incredibly
Mm.
insightful, um, a really just a first-rate intellect. Yeah. She could identify the heart of an issue faster than almost anyone I've ever met, no matter what it was. And to see that mental agility and capability in action was something. I think it was inspiring, but it was also very educational. She was a remarkably good listener, but I had the privilege of, flying all around the world with her.
That's amazing. What was the main thing you learned from her? I mean, you clearly stated she was very smart, but what did she teach you?
She reinforced a lesson, and it's fundamentally just the importance of authentic humility.
Mm-hmm.
She never assumed that she knew anything. I think when she went into a situation, she really listened carefully and thoughtfully. She had the humility to do that. And I think as an investor, humility is the only armor that holds up over time. I mean, one of the reasons our track record is what it is because I never stop asking myself, what am I missing? What am I missing? What am I missing? What am I missing? I do so much more work than the average investor, I guess. And still, I never stop asking, what am I missing? I'm always wondering, what's that blind spot? Because there is always a blind spot. You never know. The alternative is knowing everything, and you never know everything. And she had a tremendous respect for what she didn't know. We launched this investment firm. She had no background in investment management or Wall Street or any of that. She came up to speed so frighteningly quickly. It was just, we started out, there'd be meetings and she would be there and she would just be listening and maybe chime in every once in a while. And then gradually as time passed, we'd be in a meeting, discussing something, possible investment or partnership or whatever. And she would ask a question and it would just go right to the heart of the issue. And she would ask it like so succinctly and precisely. I was always, whenever I saw her about to speak, I was always thinking, okay, here it comes.
Here it comes. Get ready.
Yeah.
Wow.
She was an amazing, fascinating person. It was a huge privilege to be able to work with her and to have that bandwidth, to have that trust. But you look at her, you look at Benno Schmidt, Jim Rogers. I've led a charmed existence in a lot of ways.
That's pretty cool. Wow. I want to talk about something else now, not finance superstars, but something that is also very important within the finance industry, but completely different, which is storytelling. You said before that all accounting, either GAAP or non-GAAP, is an interpretation. But beyond the actual numbers, I think markets run on stories. So I want to ask you, why do you think narrative is so powerful in shaping markets and valuations?
Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Because as human beings, we understand things by making stories. That's our process for understanding, particularly events that might not make sense at a very basic level. I mean, you're right. I think all accounting is an interpretation, right? Because there's the underlying economic reality inside a company, for example. And then the financial statements are an accounting interpretation of those. And then you have your or management's or the analyst community's interpretation of that interpretation. So in the end, you're operating twice removed from whatever that elusive underlying economic reality actually is. And one of the ways we understand it is by transforming it into some kind of narrative. When you think about you understand how something is happening. It's not a mathematical formula. It's like, okay, I understand. So the revenue went up, and then their net went down because their costs went up because this happened or that happened. When you step back, I mean, that's usually some sort of narrative form. It's an explanation. But when you think about it, I mean, I can remember, you don't hear it as very often anymore. I haven't heard it actually in a long time, but early stage businesses on Wall Street, when I first started, they used to call them story stocks. It's because there wasn't that much there, right? They were early stage. Maybe they didn't have much revenue. They were, profitless, probably weren't going to generate positive cash flow for a long time, but people bought the story.
Mm.
And it's, stories are what people respond to. It's why politicians tell stories. When politicians make a moving speech, Martin Luther King didn't say, I have a 10-point plan. He said, I have a dream. It's people respond to stories because part of it is they want to, inherently, I think human beings, they want to be engaged. They want some sort of emotional relationship to the information.
Mm.
They want to be excited. Think about it, they go to horror movies because they want to be frightened. They want to be moved. People want to be moved.
Mm. Have you ever found yourself sucked in by a great story, a great narrative concerning an investment, only to realize too late that the fundamentals actually were pretty bad?
Yeah, absolutely. One of the things that when I talk to allocators about, reasons they have to invest with us is I say, I've really gotten a lot of mistakes out of my system. That's another advantage of starting early. You get the mistakes out of your system. I can tell you why I lost money in Commodore Computer. You remember that company?
Mm.
I mean, that was an early darling, and it was very popular, and people were playing games. I had friends who had the Commodore 64, and they had great games on it and all of that. But what I didn't understand at the time, and probably couldn't have because I was just too young, is that they didn't have the ecosystem of creators and programmers that Commodore needed to build out the software universe that the hardware needed to exist and prosper. That's really why they failed. But I've got plenty of skeletons in my closet. I think what's the difference in a lot of ways between an investment story and an investment thesis? Think about when, some big asset management firm, a Monday morning meeting, and the guys will come in there and the women, and they'll say, well, we think that this is a buy because blah, blah, blah. It's usually a story.
Mm.
I mean, they're not just quoting numbers. This company is going to become dominant in this space because of X, Y, Z, and as consumers buy more of these because they're buying these instead of those. It's usually some form of narrative. It's how we make sense of the world. Narrative is how we make sense of the world. But you have to be careful that you're, again, not making sense of something that's something where it doesn't make sense.
Mm-hmm. Yeah,
I think
sometimes it's just that.
of David Byrne in Talking Heads. Stop making sense. Like one of the messages of that album was, we make sense out of things. Think about the interpretation of historical events where we had a clear understanding of what happened and why, and just happened to be the fact that later on we found out that everything we thought and believed was completely wrong because we imposed a certain sense, a certain narrative on it. And that's where, again, it comes to, how hard are you working to truly understand what's happening inside the company, and how honest are you being with yourself about seeing that versus trying to fit the facts to that narrative that is somewhere in the back of your head.
Yeah, I have the feeling sometimes that we can almost craft a narrative for everything,
Yes.
For making a bull case, for making a bear case, and sometimes, I mean, I guess we don't even do it on purpose. It's just like the biases we have, right? And I don't know if we can do something about it. Maybe that's a question I wanted to ask you. Like, now that we have more technology, do you think that AI, for example, will help us remove away human errors and biases when it comes to investing, or is that an inherent part of the investing process?
Well, to start my answer where you started the question, I mean, at one time, the greatest minds in the world, the greatest scientific minds in the world with the greatest technology were all clear that the world was flat. I always remember that. The greatest minds were convinced and had proven, based on their technology, that the world was flat. So, as far as artificial intelligence is concerned, I mean, it's, the large language models and the other, I guess, sort of architectural structures of what we're calling artificial intelligence in general, are based on scraping human content and providing it in a form that has the highest statistical likelihood of being the answer that the questioner is looking for, right? I mean, it's artificial intelligence isn't really thinking, not yet. Could it replace human judgment? If it's as good at being irrational as we are, again, because the market doesn't run on rationality. It doesn't run on logic. It runs on human decision. I guess if the market were totally and completely conducted by artificial intelligence, that AI was the only supplier of buy and sell signals, perhaps. But then what is influencing the underlying enterprises and what's happening to them? The human decisions in corporate management, in planning, in mergers and acquisitions, and all of that sort of thing. I mean, that's what should be driving the price action. I don't think that analysis will necessarily be easy. At least the type of analysis that I do will be that easily automated because it's so qualitative in nature. The information is more quantitative than qualitative. You think about it, most of it is financial statements and numbers. And then you've got the manager's commentary and everything else, all of the verbal information, which is more qualitative. But investing, particularly, when you're focused on valuation and looking for a margin of safety, is a very qualitative exercise. Because, the price is the price, right? The price is an objective number. It's there. You don't have to debate it. You don't have to analyze it. It is what it is. Right now, the price of GE is $255.80. The price to earnings, the price to book value, the price to cash flow, the price to free cash flow, all of those other factors have a qualitative element. The earnings aren't just the earnings. It's not what the earnings are in isolation. It's the quality of them that matters. That's what Warren Buffett and Benjamin Graham and Charlie Munger and all the other deans of that school of thinking focused on. That's why they always said, don't just buy things that are trading at a low PE or a low book to value. That's not actually value investing. And that's one of the reasons I'm steering the question around a little bit, but that's one of the reasons why value investing has become so suspect. Because again, the holy grail of asset management is to automate the process as much as possible. So then you start all these funds, maybe they're factor based or whatever, that look to they employ value investing strategies that are based on quantitative factors that are basically buying things that are trading at low multiples. Again, if the market is efficient most of the time, then those companies are trading at low multiples for a reason. So they're doing exactly the opposite of what the founders of that school of investing recommended. It's not working, and they're saying value investing is dead. Which, when I think about it, the idea that buying a dollar for a dime could ever be dead to me seems irrational. It's illogical. I don't think that's not an investing style. That's basic economics. That buying a dollar for a dime can never go out of style. And that's what you're trying to do.
Yeah, maybe it's just that value investing goes beyond just the ratio, right? Like that's a part of it, like almost a condition that needs to be met.
I mean, it's the quality of the earnings. It's the quality of the free cash flow.
Exactly.
Now, artificial intelligence, to bring it back around to your original question, will it be able to do that qualitative analysis? I guess, eventually, if AI gets to the point where it can effectively replicate everything that occurs inside the human brain, maybe, I suppose. But it's sort of in the same territory of, we can have right now AI can render a grammatically correct paragraph, but can AI ever be a great writer in the realm of Tolstoy or Steinbeck or Fitzgerald?
So we're getting close to the end of the conversation. I need to be very picky with what I ask you. I have a couple of more additional questions. One is about what doesn't let you sleep at night. So I think every thoughtful investor, like you clearly are, has one or two big questions that haunts them. Something they feel they don't truly understand, and that sometimes even keeps them up at night. Could you share one of those questions with us?
Well, there's this showstopper exogenous event, a nuclear event, something so major it puts the planet itself in peril. There's that. Things that are going on with the climate, obviously, are serious issues. I mean, these could have a very deep and wide-ranging financial impact, economic impact on the world. So there's that category that are sort of planetary and existential in nature. And then there's kind of the more pedestrian layer that is, there's a lot of them. And it's coming down to, well, what did I miss about, General Electric or whatever? I'm always thinking about what am I missing? What am I missing? Do I really understand? They said this in the most recent call, and that struck me as not really lining up with what the numbers were saying. But then talking about financial reporting and non-GAAP and all of that you and I have discussed before, that disparity between the reality of the numbers and the narrative is also how you find opportunities. You're looking for that disjunction, that fissure. But there's always, if you're an investor, and you're managing other people's money, then you should be a fiduciary. And if you're a fiduciary, you should be worried about what might happen. I take the fact that a lot of my clients worked very hard for their money, and they're trusting me.
Yeah, I like that question of what am I missing? Putting yourself in the position where you're thinking there's something that I haven't considered. Like, are you sure you have gone through every single detail, and puts into question your thesis and pushes you a little bit further. And yeah, regarding the nuclear conflict thing, BCA published an interesting paper a few years ago on it. As an investor, what should you do if there's like a real threat around your region and the market is collapsing because of that? And the author argues you should be super long, because if there's a nuclear bomb and you die, then your portfolio doesn't matter. And if the conflict gets solved and there's no war in the end, chances are that the stock market is going to bounce sharply, and you want to be as long as possible. So I thought that was interesting.
The facts bear that out too. I mean, I had posted on social media. It was a while ago, but it was a chart that showed all these major events in history, like the attack on Pearl Harbor, for example, and it showed how much the market dropped and then how long it took for the market to recover to the prior point. And all of the periods, those periods of recovery, were astonishingly short. It's amazing how quickly that the markets recover. But then that speaks to so many things that you and I have been discussing. It's the narrative. It's people want to believe they have a future. And because they want to believe it, they will believe it, and they'll start acting on it. And that makes sense then why the market would recover so quickly. Because nobody wants to think we're doomed forever. They want to think, okay, we can bounce back from this. We can defend ourselves. We will defend our way of life. And they do. That narrative takes hold. And, of course, there's a very self-reinforcing mechanism with the markets, right? Because a little bit of that and the prices rise a little, and people look at that and they get enthused. And so they start buying, and then the prices rise more. And all of a sudden it becomes a self-fulfilling prophecy. Simply because people want to believe it. But people have always believed what they want to believe, regardless of the evidence.
Yeah, I should post about that at some point. I'll try to find that chart because I think it's really interesting.
I'll send it to you.
Yeah, that would be amazing. Thank you so much. One last question for you. I always like to wrap up my conversations asking about the future, the upcoming generations entering the industry. What would you say? What would your advice be for someone entering the industry today to have a successful career, maybe as successful as yours?
Work as hard as you can, learn as much as you can, and keep an open mind. You may have the idea that you want to go into investment management, or you want to do a certain kind of investing, and your first job offer, your first position doesn't necessarily line up with that. You don't know that actually isn't the perfect opportunity for you, and you may find it very interesting and engaging. And even if you don't, if you learn as much as you can and work as hard as you can, then that will be another step in the ladder that you can ascend from. I mean, I've never regretted working hard. I've never regretted learning as much as I could. There's no downside to it.
Unless it comes at the expense of other things, but I would tend to agree with you, of course.
Yeah, I mean, memento mori. I mean, you want to keep in mind that we all have a limited amount of time, and
and friends and family.
Yeah, I mean, this has been a very philosophical discussion, and that's a philosophical point. But I think it is a really important one. You don't want to get lost in your work. I mean, I think it's important, particularly early on, to accept that you're going to serve your time in purgatory. I mean, I had one job. I was working for a law firm where I went over 11 months without a day off. That was, I billed over 3,000 hours.
Wow.
You will work hard at points. I think if you're smart, part of that was, at that point in my career, it was a great learning opportunity. So I said, okay, I'm not going to be doing anything else. I'm sort of putting the rest of my life on hold, but this is not going to be years and years and years of doing this. And that's why I want to lean in and make the most of it, even if it's a huge amount of work. And I learned huge amount during that period that I had at my fingertips for the rest of my career in terms of information as well as skills.
Mhm.
Would you,
Well,
if you're an athlete and you have the opportunity to, spend a season with the Yankees, but you're going to be at the ball club every day for the entire year, would you take that deal? You can't do
mm,
anything else. The rest of your life is on hold. Yeah, I mean,
yeah,
if I wanted to play major league ball, I'd take that deal.
yeah, absolutely. Absolutely. No, I like that. I like that's a good tip. I agree, especially in the earlier part of your career when you don't have kids, and you have more time. Definitely spending time in the office and go through the purgatory, as you say, and putting in the reps is something important. Of course, it's not sustainable forever, but you gotta start with a strong base, and that's the best way to get it. So
I think so. I mean,
yeah.
listen, I'll, on a personal point, this fund exists because I had moved back to Florida because one of my parents became ill, and I wound up basically shutting down everything. I was working in DC at the time, and I wound up shutting down everything. And it was my dad, and he was diagnosed with dementia, and I stopped working completely and moved back in with my parents who had retired down here, not far from where I'm sitting right now. And for several years, just took care of my dad and my mom until he passed
Wow.
away. And um, by way of advice, um, I knew that if I did that, whatever happened career wise or anything else, I knew that I never wanted to have any regrets about how I handle his illness
Mm,
and caring for him. I had always promised him that I'd sleep at the foot of his bed before I'd let him see the inside of a nursing home. And that's pretty much what I did for several years. Uh, but I don't have any regrets. And I think
mm,
when it comes to your family, your loved ones, the people that are important to you, I think it's really important to not have regrets in that category.
mm. Wow. That's thank you for sharing that story, and I would 100% agree. Obviously, easier said than done. Not everyone would be willing to do that type of sacrifice,
Not everybody
but
is able to
yeah,
either, to be fair. You've got a
yeah,
family of your own or whatever. I wound up getting married later. And
mm,
so, I didn't have a wife and children and all that. So part of it was I had the ability to. So I completely understand for those people who struggle with it and have to get assistance for their family when they're dealing with
mm,
illnesses of that nature. Believe me, I understand it. But
mm,
I didn't have any of those impediments or barriers. And so I just, but then it was, what happened as a result is I had this entire like career reboot. Then I was down in Florida, no job, no plan. And I thought, okay, if I'm ever going to start that fund that I've been wanting to start, that I'm running now, that is a pure distilled approach to exactly the way I would run a fund, it's going to be now. And that's when I started putting together the building blocks of the fund I've been running for the past decade. And in fact, we literally launched the same month my dad passed away.
oh wow, gosh, so it's almost like a continuation, and in some way, your dad is still there, no?
I'd like to think so. Yeah, I mean, we were obviously very close. I have a very tight
Mm.
family, so yeah, I would like to think so.
Well, on that note, I wasn't expecting the conversation to take this direction, but thank you for sharing that. Yeah, that pretty interesting and emotional part of your life. Steven, it's been absolutely amazing to have this chat. I wish you all the best for the upcoming years. I'll keep a close eye on your work. You're clearly a source of inspiration for other professionals in the industry, including myself. Um, And let's keep in touch.
Listen, Nacho, I sincerely appreciate the time and the interest. It's been a really enjoyable conversation. Very unusual one. We're going to talk about investing, I guess, some in the end, but I've really enjoyed it. I do appreciate it. And I think what you're doing is really interesting. Also, I have watched a lot of your other episodes I did before having this conversation with you. And I really recommend them to whoever's watching this because you take a very different approach and you do it well. You do it well.
I appreciate that. I thought there's so many podcasts about markets out there. I want to make something different. I want to advocate for the finance profession and show that there's incredibly nice and genuinely interesting people in the industry. And that's what I'm trying to do. I'm trying to share the story and share the faces, and hopefully it inspires other people to become a better version of themselves.
And I think having these conversations where you really get into what motivates people, that's the key. I really do think that's the key. And that's what I found in a lot of the different episodes of yours that I watched that I found so engaging and interesting.
All right. Well, thank you so much. And I'll talk to you soon, Steven.
Take care, Nacho.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.